Well, the stock market seems to be ignoring the Iran oil tanker bombing, and trade talk concerns have been put on hold, with the new focus for Wall Street and therefore other global stock markets being what the Fed does to and says about US interest rates this week. It comes when the NAB has told us that it expects the cash rate to be cut 2 more times this year by the RBA in August and on Cup Day in November. Meanwhile, RBC and Macquarie think that the cash rate goes to 0.5%, but I hope they're wrong, and that will only be the case if our economy rebounds, and for that to happen, banks need to lend more to borrowers. That's something Treasurer Frydenberg really can't ignore. It's a thorny issue, but he has to get involved or else we could be in trouble with the economy. And Donald Trump, he has to crack a trade deal ASAP. Go Donald. This is our catch up with Michael McCarthy from CMC Markets and Julia Lee to see what's gone on in the market today and pick some winners and losers and also get their ideas on what they like right now. Julia, Michael, thanks for joining us.
Pleasure.
Let's go to you first, Julia. Today's trade, how would you sum it up?
It was a little bit disappointing because we started off flat in the morning and then by the end of the session we closed on the lows of the session, so down by 0.4%. I think dominating trade was the fact that we saw AGL walking away from that deal with Vocus.
Yeah.
And that meant...
How did that affect you? Because you liked Vocus on the first offer.
I sold after the first bid fell through. So
Yeah.
I guess that's a lesson of investing that I learned very quickly, is that when your thesis doesn't come through, to sell your shares very quickly. So there's no shame in selling, but the general rule is to sell early. And
First loss is your best loss.
Yes, and Vocus today unfortunately had a huge loss, down 24%. That made the telecom sector the worst performing sector. But on the flip side, AGL Energy saw a bounce of about 1.5%, and that's all utilities being the best performing sector of the day.
Macca, is there something wrong with Vocus? There's 2 or 3 potential...
I've counted 5 now. AGL twice, EQT, Affinity Partners and KKR have all had a look at the books, all pulled up the hood, had a good look at the engine and said, we're not involved. Now, that's not necessarily a sign of problems at Vocus. What it means is it doesn't suit their style. So and of course TPG was knocked back by the regulator. So in terms of equity, private equity groups, perhaps the cash flow wasn't there. It could be a negative float business, that is you've got to put capital out to get cash coming in. That's bad news if you want to service debt. In AGL's case, I'm not sure what the original rationale for the deal was, so I can't say why they walked away, but 7 days is a very quick turnaround. Right. I note that Vocus was quick to come to market today to reassure investors and reiterate its guidance of EBITDA this year of 350 to 370 mil. That's a positive in my book. So perhaps what we... Is
it a buy for you then, Michael?
Well, gee, after 5 goes at it, it's hard to see somebody else stepping up. However, the competition landscape has changed, and I wouldn't be surprised if TPG try and revisit their deal. So, look, I'm not thrilled with the overall Vocus business. It's in strategic turnaround, but at $3 a share, with potential for takeovers still in the sector, it's probably worth a look.
Okay, winners and losers. Just go you first, Julia.
Well, I guess what we've seen the last few weeks are a number of investor days and a number of profit downgrades coming through. So today the downgrades were from Macmillan Shakespeare, which was impacted by the weakness in terms of its US businesses, both in terms of asset and its broking business. And look, it's not the first time we've heard that a company on the ASX has been impacted by Brexit and the soft economic conditions over there. Yep. Recently we also heard from Link Administration. So keep an eye out for those shares that you own, which do have operations over in the UK, because it does look like Brexit is having an impact on a number of businesses. And the other was Pilbara Minerals. So it's seen a bit of a delay in a processing unit over in China, and that's impacted on sputamine sales. So we did see Pilbara Minerals down around about 5% as well.
Michael.
Yeah, surprisingly weak performance from resource stocks generally. Although we did see iron ore slide 2.5% today after what has been a stellar run, and so we could expect to see some pressure in that sector. Energy stocks also fell as a group, and that's despite a rally in the oil price. So there did seem to be a bit of a move away from that. The IT sector, which is a good gauge of investor sentiment, was all over the shop today, with payments group ML, the top performer on the top 200, and Afterpay one of the bottom 5. So there wasn't a clear and coherent investment theme in the market today, Peter. I'd characterise it as nervous trading. The disruption in Hong Kong over the last couple of weeks has fed into the regional performance. We've still got concerns about trade, and we've got a FOMC rate decision coming up 4 a.m. Thursday morning our time. And of course, the market's pricing an almost certainty of a rate cut in July. Well, if that doesn't happen, we could see some significant adjustments short term in share markets.
Just coming back to the tech sector, I was actually quite surprised that we didn't see a bigger fall in terms of our tech space. We were only down by about 0.5%. And that's given that we did see Broadcom coming down and downgrading forecasts on Friday for its revenue, and purely just based on US-China trade relations and the impact that that's having on sales. They usually say that, you know, it's not just one company that's going to come out with bad news, and that we'll probably see some other skeletons coming out of the closet here. So I'd be a little bit wary on the tech space at the moment, given that.
But some people will be watching Afterpay. So what's the high for Afterpay so far? 28. It's around 20 now. Some people will be wondering, is this a buy here? You two guys, are you worried about Afterpay, or is it a buy at these lower levels?
We've seen 3 consecutive days of losses now for Afterpay. So in the last 3 sessions, lost around about 21%. So today, down around about 6%. When the scenarios like this, valuations do quickly start to become quite attractive. But the risk of trying to catch a falling knife is that you're going to see short-term pain. And I guess I would wait for a turnaround in the share price and for a sustained recovery before getting some confidence. And for me, it's more around risk management in case the shares do fall another 10
Michael?
15%.
Can't buy this one on earnings, Peter. Not on current earnings, but it's the potential that people really like about this. And the only time you can buy these is on a pullback. So I do actually think it's worth a look at current levels, and the reason for that is I think the dovishness we're seeing in the market at the moment is at extremes. People are very worried about the growth outlook. That's why they're expecting a low interest rate environment. I think we saw evidence on Friday night. We've hit the extreme and we're starting to move back. And as we move back and sentiment swings back towards growth, Afterpay is a likely beneficiary in my view.
So I always regret the fact I didn't buy it at 11. If I see 11, do I buy it again? Or buy it for the first time?
Peter, if we see 11, you'll be racing me to get some.
But I think you also need to consider what's at the heart of Afterpay's business model, and that is the ease of paying for something. There's something called the pain of paying, where if you pay cold hard cash, it's the most difficult to buy something, especially when it comes to more impulse purchases that the younger generation likes to make. And then as you move down that curve through credit cards, PayWave, and then Afterpay, you become a lot more impulsive in your purchases. So at the heart of Afterpay's business model is the ease of paying. And if you put a few more steps in there for identification, verification, make it a little bit more difficult, then it doesn't become Afterpay's business model. It becomes a little bit more closest to ZipPay, which has a few more. It's a little bit harder to sign up to.
Yeah. Do you like ZipPay?
I do like ZipPay.
Okay,
I like
go.
Afterpay better.
Okay. You guys, thanks for coming on the program.
Thanks, Pete.
There's some insights from people who watch the market 24/7. The poor people have got nothing else in their lives. My next guest is RUDI FILAPEK-VANDYCK, the founder of FN Arena, and arguably the second most entertaining person in the market behind me. But great to see you, RUDI. Maybe you are more entertaining.
Next to you.
It's good to see you, mate. And I think a lot of people, a lot of people don't understand FN Arena. So you probably just, nutshell should explain what FN Arena does.
Yeah, in a very short nutshell format, we amalgamate information from the main experts in the market, and we make it available to people who usually don't have access.
Yeah, and why I like to ask you your views on various stocks is that you're constantly watching the analysts whose main job is to try and get it right. And
Yes.
you would know that their strike rate's not as 100% as we'd like it to be. But have you thought it through over the years? What do you think is the reliable strike rate?
6 out of 10.
6 out of 10?
6 out of 10, yes.
Yeah, okay. I knew you would have thought that one through. And recently I've looked at companies like Link, and I think Link's got, according to the people on your website, about 25 or 29% upside. Do you agree with that? And because some companies you would say, I don't agree with the analyst. But with a company like Link, give it time, say 2 or 3 years, do you think a 25 or 29% rebound is likely?
Probably yes. I do agree with the general sentiment from for many analysts now that the market will probably be very cautious now.
Yeah.
I mean, I'm the same. I mean, from the moment the company has to issue a profit warning, whether it's the regulatory chances or anything else.
Or a Brexit clause or whatever it might be.
We don't like companies issuing profit warnings. I maybe have to point out, I own Link shares as well.
Yeah.
Because I'm as disappointed as many other people.
Yeah.
And things happen. I have decided to stay on board, taking the view that hopefully they can ride the path. But sometimes as a company, you don't have everything under control what happens to you. And then investors have to make an assessment whether they are willing to wait or just move on to companies that have a different profile.
Yeah. Well, a number of guests I've talked to in recent times have often said to me, your first loss is often your best. But it's not always the case, is it, really?
No.
It's a generalisation which not as always right.
No, exactly. What you have to try to assess as an investor is whether the first loss is a sign that more losses might be around the corner.
Yeah.
And then staying on board simply because you've paid more for the stock, that's a bad decision.
Yeah.
But if you can take the view that that's not necessarily the case and there might actually be improvement on the horizon, then selling might not be the right decision.
Yeah. I know Charlie Aiken has said to me in the past that he dumps the stock when the facts change.
Yes.
He said, not just a sentiment,
Exactly.
the facts have to change.
Yes.
I think that's a pretty good rule of thumb, isn't it?
Here's probably a better way of putting it. Once upon a time, I owned shares in Slater & Gordon. And there were, up to a certain point, they were the best performing stock in my portfolio. Then they did an acquisition in the UK. The market didn't like it. Share price went down, and actually all my profits disappeared overnight. And I was sitting there, am I going to take a loss or not? I decided on that basis, I don't like the profile going forward, so I sold. And ultimately, I don't remember what my losses were, but let's for sake of argument say I took 15 or 20% as a loss. Ultimately, the share price ends up 96% in a loss. So I took 20, maybe, to avoid 96.
Yeah. Good point. All right, now I've asked you to come along to give us the best 5 stocks that you think should be in someone's portfolio, particularly if they're a startup. Like if your son said to your dad, I want to put a portfolio together. I know they wouldn't. They love you so much they wouldn't ask you.
No, they would definitely not ask dad. You know that sons never do that.
No. But if someone did, what do you think are the core 5 stocks you think should be in someone's portfolio?
I think something that is not explained well enough to investors, I think, on occasion, is that you have stocks that are running for a while. You have stocks that are running because they're cheap, and there's a selection of stocks in the market which are simply that good that they are very good to have in your portfolio under any circumstances. Whether the RBA is cutting interest rates, whether there's a recession looming in the US, it doesn't matter.
Okay.
Yeah?
And then, by the way, before you tell me, I'll be very surprised if you don't mention the 3 letters CSL. But I'll wait till you tell me it.
Well, I'm taking it. You're right, but I'm taking a little bit of a different view here. We have, and I hope investors do realize this, because the longer I do this, the more I'm convinced about this. We have some of the highest quality stocks on the ASX listed in the region. And 3 of them are exactly healthcare stocks, and they are CSL, Cochlear, and ResMed. And irrespective of what I find and what analysts are saying and what the valuations potentially can be in the future, anyone who opens up a 10-year price chart will see that those stocks, they start at the bottom in the left-hand side, and they end up on the right-hand side at near the top of the chart. That is a long-term uptrend on anyone's account. Right? You show it to a 5-year-old and they go like, it goes up. Right? And that's all you need to know. Right? Now, the next decision to make is, when are you going to own them in your portfolio if you don't already own them?
Yeah,
right?
good point.
And I would say maybe now is not the time to chase them. They've just all had a rally, and quite a big one. And so you wait. And I heard Michael McCarthy saying earlier, certain stocks you buy in a pullback, those stocks you buy in a pullback. When exactly do you buy them? That is the how long is a piece of string question.
Well, I guess, and some people have asked this question, if I'm not in the market, should I wait for the ultimate market crash? It could be 2 or 3 years time.
But exactly, it might be waiting for
That's
10
right.
years. That's the problem with that.
Because the longest bull market's 15 years and we've been going 10. So it could be a 5-year wait, couldn't it?
It sort of depends how you define that and things like that. I mean, some people forget that there's, in between what they define as a bull market, you still have these big pullbacks. And in Australia, for example, you could have bought in 2011, 2012, and the share price did go down quite a lot, 19% over that period. So, I mean, is that the end of the bull market? It turned out it wasn't. But in general terms, I find my strategy is that I don't go in full force when I add that type of stock to my portfolio. You add some, you see what happens first. I mean, if the share price goes up, you're already winning. I mean, if it goes down, you shouldn't be worried because you want to have it in the first place. So then you buy some more, right? Which is different from buying more because the share price goes down by default, because you might just be throwing good money after bad.
So are those
the three healthcare stocks?
They're 3 of your 5, are they?
And then I would add the 3 platform stocks we have in Australia, and they are of course REA Group, Car Sales, and SEEK. And those are 6 stocks. You
called them platform stocks, but they're also, they're not quite high tech, but they're internet stocks, aren't they, in many ways?
Yes, well, yes. So
they've got a modern feel to them.
But yes, so someone like Morningstar would say those are no-moat companies. I disagree with that.
Explain what no-moat means.
No-moat is also very famous because of Morningstar, but also because someone like Warren Buffett uses it as well. And it means that you have a defense wall around your business model, so the competition finds it very difficult to enter your space, basically. That's the medieval view. I disagree that companies like REA Group, Car Sales, and SEEK have no moat. I actually think the fact that, and that is also being proven by analysis and experiences overseas, if you are the leading player in that type of markets, often that's enough of a moat in itself. For example, I've been a shareholder in REA Group and in Car Sales for quite a while now. The occasions that competition has tried to catch market share, either of Car Sales or of REA Group, and even the Americans coming into Australia, every time they've successfully fended off the competition. And every time the share price and the profits and the dividends ultimately end up at a higher level. So I've seen no reason why that is different. So I think if you want to buy high quality and have that as a core as your portfolio, I think the healthcare stocks, the top of the healthcare space.
Which is a growth industry too, is it healthcare?
They're still sustainable. It's still,
we're all getting older,
it's not like we
and
cure,
we need
cure all
more
diseases tomorrow. And the 3 platform stocks, which what we have in Australia. Well, we have more platform, but those are the 3 best ones we have. I think that's an excellent
starting point.
Yes. And the more you observe those companies, the more you analyze them, the more you realize what makes a good company with good management.
RUDI FILAPEK-VANDYCK, always great to catch up with you.
My pleasure.
That's RUDI FILAPEK-VANDYCK from FN Arena. Coming up, we'll be talking to Charlie Aitken and Paul Rickard about how Charlie picks stocks and when he knows it's the right time to get out. This is our chance to catch up with Charlie Aitken to see what goes on inside the head of a fund manager. I'm joined by my colleague Paul Rickard, who will also grill Charlie to the best of his ability as well. Mate, great to see you.
Afternoon, Pete. Paul.
All right, so the market today, what did you learn today?
You're learning every day, aren't you? You know, like I think always trying to look at the future, always trying to own the best companies. I think there's always defensive and offensive characteristics in owning the best businesses you can. So you're always learning.
Are you surprised that the oil tanker problem in Iran hasn't seemed to spook the stock market?
Yeah, not really, Peter, because I'm not sure everyone understands what's going on there. But look, they'll come back to that if something serious happens, I guess, but the market can move on. You asked me what I learned today. I thought the interesting part of today was the reaction to AGL pulling the pin on Vocus so soon. And I guess that was, the market said that as much last week when it refused to get anywhere near the so-called offer price of $4.85. And then after 3 days of due diligence, I think they almost a record, right? They pulled the pin. So obviously, there's 2 scenarios are possible, and there's probably truth in both. First of all, I think there was so much feedback from the market to AGL about what are you doing in the power business? We don't quite get the strategic fit. I think that was the first point. But secondly, the Vocus stuff got to look pretty horrible because that's about the 3rd company that's walked in there and within a matter of days pulled out of a due diligence operation.
Charlie, have you ever looked at Vocus?
Not particularly, no. I think I once shorted it, actually. It was a very highly valued stock. I think this is a bit of a situation like having your house open for inspection. Everyone keeps inspecting it and no one's bidding or withdrawing their bids. So there's something that the potential buyers don't like. Anyway, that's not one for me. I don't think I need to be in second or third tier telco providers.
No. How do you pick your stocks?
Well, I always like to own the number one player in the industry. I mean, I think that if you're going to look after people's money, you've got to have that money in the best companies you can own for the longest period. So I always look for the number one player in the industry, usually the dominant player who continues to take market share, who's disrupting rather than being disrupted. And I look for great global brands. I always think brands are safety too. Great brands always bring you a bit of defensiveness as well. So I want to look at the portfolio every morning and just see that I have the best companies in the world, what I consider the best companies in the world. And then the market goes down, well, I go down in the best stuff.
I can't remember what your attitude was when BHP got into the $14 area. I think I do recall praying that you'd actually agree with me that it was the right time to buy. But that was a classic example. A great branded company in trouble at the time of the market. It probably, for a contrarian investor who's got time on his side, you have to perform, on a shorter time frame.
I think industry structure always eventually protects you. If it's a monopoly or a duopoly or a couple of great businesses competing. If you think about BHP when their dam collapsed in Brazil, it was a once in a 20-year chance to buy the stock.
Yeah.
It's probably what's happening in Boeing now. In the next few months, there's a chance to buy some Boeing shares. It might be happening in Bayer, who makes Roundup at the moment as well. There's a bunch of companies around the world that are great businesses that are getting belted. It was the Australian banks before the election, really on the nose, and then suddenly bounced 15%. So I think industry structure, that being a very the number one or number two player, generally gives you protection. So that's what I look for.
Yeah, look, I think there's a lot in that being number one or number two. I think that's actually a really good strategy, and also looking for industries where you've got protection. But back to the one or two, I mean, I think you can see that almost in the Australian banks. I mean, I've always basically been long Commonwealth Bank because it's the best of the major banks, has been over the last 2 decades, and it's been the best performing. So lots of times I've heard how people should look at the National Australia Bank or others. It hasn't been a good strategy, and
it's about the same price as when I was at school.
Yeah, it was the most expensive bank in the early 90s, and now it's the cheapest.
It still is the business bank, isn't it?
Yeah, but look, again, you can look at the same. Just coming back to your BHP example. I mean, BHP is the number one Australian mining house, the best diversified. It has the best deposits. Look, and it's done probably better than the others have. So I think just in a local example, I know where you're going from, Charlie, more in a global sense, but I think in the Australian market you have a choice, and it comes back to the Vocus a bit. Why do you even worry about Vocus when it's not number one? I'm just raising it as a question of it taught me something today.
Yeah, but now when do you sell, Charlie?
When the facts change. I think that the natural temptation is to overtrade portfolios. Remember, I used to be a broker, and brokers want activity. That's how you get paid. I think there is a natural inclination with the 24-hour news cycle and Twitter and Facebook for everyone to overtrade portfolios. I will sell a stock if the facts change. If I'm wrong, I'm happy to sell it. If I'm wrong, and even if it's down 20%, be done with it.
Yep.
But if the facts aren't changing and our forecasts are in line and the company's delivering to what I think it should, and then I'll stick with it.
Okay, let's stick with the 10-cent one, because that's a company you always liked.
Still got that, yes.
And it suffered because of the trade war. Was that the main reason?
Well, the thing is, there's sentiment and then there's facts. Sentiment can play a big short-term influence on any share price, no matter what it is. Look at Australian banks. Nothing was really changing. The market was just fearful of a change of government. It bounced 15%. So if the facts haven't changed in our view, or the earnings forecasts haven't changed, but the share price has, because of some sentiment reason, be it trade war or whatever, then we'll try and take advantage of it.
When do you sell, Paul?
Look, I'd probably like most people look at targets a little bit, but I guess you also learn that looking at targets, markets always go further than you expect, and so you sort of put that away a little bit. I think that's a good place to start, but I think Charlie's answer about when the facts change. I mean, the other thing I've learned too, Peter, is there's the old investment adages are usually pretty right. So the other thing when you sell, of course, is that when something's going wrong, going badly. And I think that the adage, your first loss is your best loss, it tends to be true about 8 out of 10 times. And when you've got something wrong, the sooner you recognise it, the better. You can always buy back again, right? You can always sell something, get out and say, well, that was a mistake. I actually really like that stock, and buy back again. But just getting that sort of almost the the clean air it gives you because you're not worrying about it anymore. I think there's tremendous relief as an investor in that.
The natural temptation is to take profits in things that have done well and let your losers run because you think they'll get back to the price you paid them. The very best fund managers are ruthless cutters of losing investments, and they try to let their winners run. And if we all did that, we'd all outperform the share market. But we all tend to get stuck the other way.
Best pick and what you learned?
Oh, over the last 20 years, the most controversial yet rewarding thing I've ever been involved in was Fortescue. At 60 cents, no one wanted to believe it. I got ridiculed in the press relentlessly. And then here we are, 10 years later, and Andrew just paid himself a 660 million fully franked dividend. One of the richest men in the world.
Right. So what did you learn from it, apart from the fact that you were right and everyone else was wrong?
No, it wasn't about I was right. I thought the market was too bearish in its assessment. I actually never thought Andrew would pay himself a $660 million dividend. I didn't see that coming. But I just thought the market was too bearish. I went to visit the assets being built, and they were well ahead of what I thought they were, and I just thought the risk reward was in favour of reward. I think that was and I think there was another one. I think in my broking days, being involved in Qantas when they were under $1. Again, industry structure, only 2 players. The economy couldn't open for business without Qantas. It wasn't going broke. The frequent flyer business was worth more than the share price, and I think that you were getting paid to take the risk. So both were out of favour at the time, but to me, that's where you get your biggest reward.
Paul, best pick?
I think the best pick, Peter, was investing during the GFC. Particularly when they had all those heavily discounted rights issues, and the banks, Commonwealth Bank raised money at $26, I think it was. And the banks were getting market share. So bizarrely, in an issue when people might have been worried about the structure of the industry, all the money was flowing into the major banks. The government was supporting them, and they were raising capital, and that was just a bargain, So you sort of had to roll the house up a little.
So the lesson is to buy quality companies when the market is really, really negative.
Well, old Buffett saying, whenever others are greedy and others are fearful, you should be greedy, right? And not quite the same, but you know what I mean, Peter. That's the opportunity. So I think that's one of the best.
Worst pick, Charlie, and what you learned?
Oh, I've had a few in my time, but they've generally been mid or small cap stocks. I would say that the worst ones I've ever had were sort of mid-cap stocks, some sort of thing that went wrong, you lose 60% of your money instantly.
So you broke your rule in the sense they weren't the top 2 in the performers.
I don't have any of that in my portfolio right now, but over time, the punishment in mid and small cap stocks, if you get them wrong, is exponential because there's no liquidity. I mean, there were some mining service things I was involved in when that blew up when I was a broker and things like that. The punishment is so large that you don't forget the lesson.
Paul?
Look, I invested in a cash box once without understanding what a cash box was.
It sounds good, doesn't it?
So,
a cash box, a box full of cash.
In the 80s, I think maybe it was the early 90s.
When bonds one?
Maybe it was still in the 80s. Cash boxes were favourable. Just companies raising money with a plan and no core business. And because of the name involved, I thought this was going to win. Of course, it was just a way for people to take fees out of a fund. And of course it went nowhere, and I think I ended up with almost nothing back. So it was all spent. So look, again, that was without doing your homework. So the lesson there is if you don't know what you're investing in, don't. Understand the business first before you invest. And then look, you're not going to make every great opportunity is not going to fall in your lap. You've just got to accept that you're only going to get some of them right?
I would say my biggest regret is not something I owned that went down. It was not buying enough of something when it was down. A great company when it was down. I mean, the little flesh wounds of something going down that's 2% of your portfolio you can live with, but BHP at $15 or something like that was a gift from above. And you just look back and you go, I should have gone harder at that.
But is part of your problem now you're in funds management that you can't really take a 3-year view because you're the people who you're investing on want you to perform at least on a quarterly or even an annual basis?
To a degree, but it depends if you can educate your investors to go, look, I'm really going to run this for 3 to 5 years. I'm not looking at this every 3 to 5 minutes. Don't look at the monthly performance. It's the month could end on a bad day. It may make you look silly and you get it back the next month, a bit like May and June this year. So to me, it's about trying to make sure your investors are aligned to your investment timeline, which is genuinely 3 to 5 years. You're not a trader, you're not a day trader, but you get there with that. I don't look after institutional money. I look after private money, individual people, and they are better at understanding the medium term, I think.
Okay. Charlie Aiken, Paul Rickard, thanks for joining us. More insights from people who really do know the market. That's the show for this week, and as I said earlier in the program, let's hope Donald Trump can get that trade deal happening ASAP.